Hello, good afternoon, everyone. Fun day today in the markets. And by fun, I mean relatively flat, not a lot of movement directionally. We're going to unpack sort of how it fits into the big picture. Bond markets closed for the holiday, but a big earnings week. So we're going to look at the charts, think about the long-term trends. We got my guest, Ryan Dietrich from LPL Financial, is going to talk about the presidential cycle and what to think about that from between now and year end. We're going to do a deep dive into communication services, which is a really interesting sector with a lot of moving parts. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Good afternoon. This is Dave Keller, the Chief Market Strategist at StockCharts.com here at the global headquarters in Redmond, Washington. Thanks so much for joining us today and every day. This is our third full week with the Final Bar, our closing bell show. I want to appreciate all of you that have come along this journey with us, and welcome for those of you that are just joining today for the first time. Our goal with the Final Bar is to sort of digest the movements of the trading day and as much as possible connect the short-term fluctuations we saw today with the long-term trends and try to make sense of the movements, all the fluctuations. And again, one of the toughest things to do, I think, a lot of times, especially as a long-term investor, is disconnect from the short-term supply and demand and the short-term fear and greed, all the short-term movements, and just make sure we have a proper focus on the long term. So with that in mind, let's look at today's price action, how it fits into the long-term trend. So we're going to start with a chart of the S&P 500, the daily chart here. So we'll switch there. Now we're looking at today's action. That's this candle on the far right, this bar. Those of you that are candlestick aficionados, do you know what this is? Any guesses? This is the doji candle, which don't worry too much about the name. Essentially, with candlestick analysis, it's when you have the open and close right at the same level, and then the high and low sort of above and below that point. So it's where we open, we fluctuate around that opening price, but then at the end, direction really haven't gone anywhere. And a doji candle usually, by definition represents indecision, but usually means a short-term reversal because whatever trend you had leading up to that point is essentially stalling because you don't have any further momentum in that original direction. So usually suggests a reversal in the short term for the next day or two, but we'll have to see what the market has in store for us tomorrow and beyond. But that's sort of where we're at. So we opened a little lower than Friday's close. Friday, obviously, the big jump higher. And again, this one day's price action that we had today sort of summarizes what we've seen from the last 6 months, I would argue, right? Sort of this choppiness, this equilibrium, this fluctuation around a center point with no real directional momentum to speak of. Here's what today's trading looks like relative to the previous 4 days. So this is Tuesday through Friday into last week, and then today's trading. We noted on Friday how we had a lot of selling going into the close, and the last couple days, 4 out of the 5 days last week, we had that pattern, which was, the end of the session, all of a sudden you'd give up all the gains. And usually what that means anecdotally is institutions, which are the ones that tend to get involved in the last 30 to 60 minutes, doing a lot of selling, doing a lot of profit taking or distribution, and that's what's pushing the price lower. Now, today was a little strange. The bond markets closed for holidays, so less volume than normal, but overall definitely a holding pattern. And as I mentioned before, we're getting into a week with a lot of earnings. This is a lot of the banks reporting earnings. We've got Netflix, airlines. I mean, there's a bunch of companies coming out that certainly has the potential to be a catalyst to the upside or downside, depending on what happens. Let's look just in a little more clarity on the market averages, on the sectors and themes, and see what sort of information we can pull out of this. So the major averages in the top here, all relatively flat. The S&P up the most, but nothing really significant there. Noteworthy on the major indexes looking down that, again, we had the mega caps, the S&P 100, flat to down just a change. But if you look down mid caps and small caps, down 0.4%. So really much more weakness from that side of the market than from the S&P 100. The Nasdaq 100 up the most out of all of those. At the sector level, you had real estate and financials, the only two that were up. Financials, again, with all the earnings coming out this week, I think it's going to be an interesting space to watch. A lot of the big banks, JP Morgan, Citigroup, both tomorrow before the open, if I remember right. So there's a lot of potential movement, a lot of catalysts in the financial space. But real estate, a really defensive sector, up number one. But at the bottom, you had things like consumer staples, utilities, which are also, pretty serious defensive plays. So not a lot of really directional indications from what we saw there. We're going to look a little later at shifting stocks. We're going to look at some of the stocks that have had the most movements today. You'll see a lot of biotech names up at the top with in terms of big movers. That group, the biotech ETF, was up over 1%. So on a flat day, something up that much is really telling you something. And then gold, which is really not following stocks, that's following spot gold price, essentially up a good amount. And then semiconductors, which we've talked about for a number of times as sort of a good broad market gauge, up a little bit as well. So some of those groups that were up the most. At the bottom, you had some energy groups. You also had retailers down the most. So consumer discretionary is one of the sectors we've talked about many, many times on the show, and certainly remains a group to pay attention to, mainly because it's such a diverse sector, right? You've got a lot of different companies and a lot of different relative movements there. Let's take a look at a couple more charts here. This is a chart we've referred to a number of times. It's part of the Mindful Investor chart list. And it looks at the S&P 500 and then market breadth by cap tier. So this is looking at the market breadth in the form of the cumulative advanced decline line for the S&P 500, and then for the broader New York Stock Exchange, for the mid-cap index, for the small-cap index. I color code these subjectively just based on what I'm seeing and whether I think that the advanced decline lines are more supportive or more not supportive of an uptrend. What's interesting, I've had these color-coded red for a while. If you look just today, in the last 2 days, all of these have actually rotated back above this support level we've talked about. And the mid-cap index, even with the weaker move today, rotating up a little bit. So I might have to recolor code those, maybe switch those back to green, depending on how things played out. And then one final thing I just wanted to point out before we get to our next segment was the new highs and new lows. We've talked a lot over the last couple of weeks about the absence of new highs, right? So as you have the market trying to push higher, you have less and less stocks that are seeing new 52-week highs. And in a healthy market, if things are actually going well, and if you see a good amount of accumulation, you'd want to see a lot of stocks making new 52-week highs if you're expecting further upside, because you need that momentum of companies, sort of breaking above their previous peaks. And what's interesting is just today, you saw actually a lot more new highs than we have on average. So today we actually had 29 new highs on the S&P based on this snapshot, and no stocks making a new 52-week low in the S&P 500. So on a flat day, certainly leaning more positive than negative if you're just looking at the new highs list and looking at how many stocks are breaking higher. So we'll have to see again through the rest of the week, a lot of earnings, a lot of potential catalysts to pay attention to. In our next segment called Shifting Stocks, what we like to do is bring up the member dashboard, which again, if you're not taking advantage of this part of StockCharts, you're missing on arguably the best one place to start with. This is sort of your dashboard. This is your main launch pad, your launching point to analyze the markets in much further detail. And if you're equity oriented, there are a lot of ways to sort of slice and dice things that I'd encourage you to take advantage of. And one of the ways I have my screen set up is looking at scooter reports. So this is using the StockCharts technical rating. It's the proprietary rating system we've developed to rate stocks on a percentile basis. So we look at a large cap universe, mid cap, small cap, and also some international sleeves, and rank them from 1 to 100 and all the decimals in between on how strong those trends are, right? Where they're at relative to all the other names that are out there. And I have mine screen set up where I'm looking at the top 10 by scooter ranking, and then the stocks in the large cap space that have moved up the most, then the ones that have moved down the most just today. So again, in general, I'd like to review which are the names that are up at the top. We've had a couple of these names pretty consistently. They shouldn't change a ton unless there's a big move in the markets, which certainly can happen. But you have something like Target, KLAC, a semiconductor, up at the top of the list. Target's been a consistent one, breaking to new highs on new closing highs on Friday, down a little bit today, but still holding up pretty well. You've got a dollar store, Dollar General up as well. One that I wanted to highlight just very quickly was Newell Brands, NWL. This is in consumer discretionary. It's part of the durable household products group. But what's interesting, and I like to bring up this example right now just to illustrate, when you're thinking about shifting stocks, a lot of times I find people focus too much on the broad equity indexes, right? Here's what the S&P is doing. a rising tide lifts all boats. So if the market's doing okay, then stocks should be okay. And if the market's doing poorly, then stocks in general are doing poorly. And generally speaking, that's probably a fair summary, a fair generalization. But regardless of what the broad market's doing, there are always stocks making unique movements. And that's why if you have the ability to invest in individual stocks, you have opportunity because there's so much diversity, so much dispersion of returns across names, across sectors, across groups. And so I like this as a visual example that there are charts that look like this, right? If you think of it, it's completely different from the broad S&P, which has had the run up in September into October, the choppiness and trying to reclaim the previous highs. But look at how something like NWL has had a clear rotation from a distribution phase to a consolidation or a sideways phase, and then an accumulation phase. Again, just going to new closing highs again today. So I'd encourage you to look at those lists just to see names that look different than other ones out there. Looking at the large cap up movement. So these are the stocks that have moved up the most today. We find a number of interesting names on here and all some compelling charts that should be on your radar, if not already. In the technology sector, we have HPE, which is Hewlett Packard Enterprise. And if you look, you can see that this has, again, been sort of a choppy trade after rallying the first week in September. Lower highs, lower lows, but again, a break back above the 200-day moving average. You look in a stock like this, sort of that 1525 to 1550 range, which lines up to the resistance we had back here in July. So if it's able to eclipse that, and it was up, over 4% today, so clearly a pretty big mover. But if you look, it's able to, claim that resistance level, could be really compelling. In terms of stocks that actually have broken above resistance, interestingly enough, this is in utilities. This is PPL, which is an electric name. But if you look at this consolidation phase from March through September. We hit a peak in September, and now just today, Friday, nice gap up, a nice move higher, close higher, and then today the follow through, closing to new closing highs for the year, breaking above a resistance level. So PPL certainly on the upside and the upswing. I also wanted to point it out in technology. There's some semiconductor names that popped up here. We talked about KLAC as one of the strongest across all the large cap space, but look at something like AMD, which has rotated very nicely, now broken above its most recent swing high. That 2950 level was pretty key for a number of days in the last 2 weeks, now broken back above the 50-day moving average. You'd want to see as it pulls back at some point if it's able to confirm a higher low, but if that's the case, then in a pretty constructive point there. Also noteworthy enough that there are some healthcare names on here, HUM, HCA, worth looking at if you're not as familiar with it. Down here on the downside, so these are stocks that have moved down the most, and I just wanted to highlight one or two of these within utilities as well. You had NI broken down through support, and again, all else being equal, I don't like something like this where you have a clear support level, you break below it. You always want to see tomorrow if you get some sort of downside follow through on there, but there are a number of names on the moving down list. CAG, which is another staple name there, come to mind as names to follow. So that's the shifting stocks for the day. And again, using the member dashboard, if you're not using that, make sure you do it and look at the scooter reports. It's a great way to just identify where there's movement within the equity space. We're going to take a quick commercial break. We'll be back with my guest, Ryan Dietrich from LPL Financial. Be right back.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back. This is Dave Keller, Chief Market Strategist at StockCharts.com. Thanks again for joining us on the final bar. I want to welcome on my guest, Ryan Dietrich from LPL Financial. Ryan, welcome to the show. Thanks so much for coming on.
Hey, Dave. Thank you very much for having me. I've listened to the show for a few weeks. I'm a big fan, and I'm honored you invited me today on what turned out to be the second most boring day of the year. S&P only in a 33 basis point move all day, so we'll come up with something to say, but my, oh my.
I promise we did not intentionally do that and try to make it a little lower, but we take what we can get, right? So I always coach our viewers to make sure that they have a proper long-term perspective. So I love some of the charts that you sent, trying to think about the presidential cycle. So can you talk us through the first chart here?
Yeah, Dave, I sure can. So, look at last year. Now, what we have here on the screen is the 4-year presidential cycle. I think the thing that's important to note, the dark green on the bottom is the max pullback per year. This goes back to 1950. And then the top green is the return a year later after those lows. So let's focus on the midterm year one, which was last year. Dave, the largest pullbacks take place during a midterm year. We had a 19.8% correction in the fourth quarter last year. The worst fourth quarter since the financial crisis. The first year since the Great Depression. December was the worst month of the year. I think the key thing at LPL research that we tried to note, big pullbacks for whatever reason happen in midterm years. The really good news, though, is what happens a year off those lows. And you can see a year off of the lows, you're up over 30%. Now, the lows we know were December 24th last year. The S&P as of the second is up 26% from those lows. What this chart says is, hey, maybe we could be up 30% by the time, or over 30% by the time Christmas Eve rolls around again. And there's lots of other things to look at, but it's so important to note this is a pre-election year. Been higher every single time since World War II on a total return basis. A year off those lows, you've been higher every single time since 1950. So sometimes the calendar plays in, and it's never that simple, but this is something that we looked at and said, man, are we really going to go into a recession? Are we really going to have a bear market this year? This chart is one we shared a year ago right now. It said no. Unfortunately, so far, it's played out.
Very interesting. Your second chart was thinking about just corrections and how to process those. What do you see here?
That's right, Dave. We have at LPL over 16,000 advisors, and I'm the senior market strategist for them. And I like to point out the fact corrections happen. What we show here is just how many times you have a 5% correction per year. We just had our third 5% correction recently. So yes, this year feels volatile. All the headlines about trade and China and the drama out of Washington. Yet, here we are in the bullish fourth quarter. October is usually strong. I mean, think about this. This is a pre-election year in the month of October. Since 1987, October has only down once during a pre-election year. So the bulls still are in our side here, we think, seasonality-wise. But looking at this screen here, we've had 5% corrections this year. That's normal. We've only had a 7% correction from peak to trough all year. That's actually abnormal. So this year might feel with the headlines really scary and frustrating. But my, oh my, S&P's up, nearly 20% for the year, and it's been relatively modest with just 5% corrections. It's really important to have that context, I think, when we talk about big picture views and how things are going.
It's funny, in the heat of a correction, when the market actually sells off, we that's when the emotions tend to come out. But this is such a great reminder of how often we have these sorts of movements. It's not abnormal, right? I mean, not having one is actually more abnormal than having a correction. That's a great slide.
All right.
The last one was addressing the president, and I cannot wait to hear your conclusions from this list. Yeah,
one of the most popular questions we obviously receive is about the election coming up in 13 months. And, we don't really have an opinion there, but here's something I think is really interesting that people should note. I took a look at when you have a recession. I know this is, we're talking technicals here. I know we're going to get a little fundamental here on this last one. When you have a recession within 2 years before the election, what tends to happen, the incumbent president tends to lose. If you don't have a recession, Dave, and you can see it here, which says no recession, the last 11 times we did not have a recession 2 years before the November election, the incumbent president won every single time. The time it didn't work was Calvin Coolidge back in 1924. If you have a recession, 5 of the 7 times that incumbent president actually lost. So what did Carville say in 1992? He was Clinton's advisor. He said, it's the economy, stupid, meaning the 1991 recession was in everyone's minds, and then President Clinton beat President Bush in the election. So this is just a big picture thing of, hey, if we're going to have a recession, that could be one thing. If we don't have a recession, maybe people are in a good mood. It could mean another. I'm Switzerland here. I'm not making any predictions. I'm just saying it's really interesting, what happens here. 11 out of 11 times, man, you don't have a recession, the incumbent wins. That's pretty powerful, I think.
And again, not to get too deep into some of this, but it strikes me, this reminds me a lot of Robert Prechter's work, thinking of socioeconomics and just, social mood and how people are thinking or feeling about the economy and their job and all of that. And then that compels them to take certain action, which you certainly seem to be, hinting at here with the table.
No, absolutely. I'm a big fan of that. And, you mentioned, Mr. Prechter, today is actually my 13th wedding anniversary. So we've hit a Fibonacci number today, Dave, 13. So, you think about the way everything's connected. Maybe this will be a good year for my wife, Emily, and I on our 13th anniversary. We're going to dinner tonight, but maybe a better year this year.
I certainly hope it's a great one, and happy anniversary, Ryan. Listen, thank you so much for coming on the show. These are 3 really good charts and a great reminder to everyone to sort of take a step back, remember these cycles and the corrective patterns and how they're all happening. I mean, don't get too caught up in the short-term noise that you forget to pay attention to the long-term. Ryan, thanks so much for coming on the show. Appreciate it.
Dave, I would be remiss if I didn't say OH.
IO, back at you.
Yeah, Buckeyes looking good. Thanks, man. Appreciate it.
That was Ryan Dietrich from LPL Research. I promise I did not feed him an Ohio State line, but always happy to have someone bring it out on the show. So Ryan, thanks so much for coming on today. In our next segment, we're going to do a sector deep dive. What we like to do occasionally is take one of the sectors, dig in a little further, look at some of the themes, some of the stories. And again, my goal isn't to, tell you exactly what to do or what necessarily how you should think about it, but it's more to nudge your thinking on your process, right? How are you using StockCharts.com to draw some of these conclusions, to sort of pick apart a sector and think about some of the thematic movements that can help you understand things? And again, just not get caught off guard by things that you see, all the patterns that you see in the markets. So one of the ways I like to do it is to take the sector group. So this is looking at communications services, and it's looking at it on an RRG chart. This is a relative rotation graph, Julius de Kempener's work. And again, if you're not familiar with that, go to the chart school on StockCharts and look for RRG. You'll have a lot of good articles, some videos to sort of help understand it. But what I like to do here is look at some of the groups. Now, if you're not familiar, a lot of people don't know a lot about communication services. This used to be sort of the old telecom sector. So if you look at the bottom here, it's listing out some of the Dow groups that make up this sector. It's kind of a mishmash. Originally, one of the S&P sectors was telecoms, and it essentially just had 2 names. It was AT&T and Verizon, and then some smaller names randomly would be in there. But that was it. And those 2 stocks made up 80% of the sector, and you really just need to understand those. But what's happened is they reshuffled all the S&P sectors and made the communications services sector, and it included the telecoms. Also included media names, or something like Disney would be in here. Also internet names, things like Facebook are in here. So it took some stocks from technology, some stocks from consumer discretionary, and then the old telecom names, put them into one big sector. So it's an interesting one because it's newer, and even a lot of institutions don't have a lot of experience sort of managing the sector and thinking about some of the group rotation. So it's an interesting one to look at, especially now that there's a real mix of offense and defense, right? So in the upper right corner here, this is the fixed line telecommunications. This is something like AT&T, Verizon would be in this group. You can see them up here in the upper right, which means they've been leading. They've been the strongest group on a relative basis by the fact that they're further over here to the right. In terms of what's improved, it's mobile telecom, which is here in the center. We'll look at some of these individual names here momentarily. Down rotating lower, you have broadcasting and entertainment. And in the far, bottom left, you have media agencies, which is sort of a smaller subset within there. And then internet sort of right there in the middle, sort of fluctuating around. So that's sort of how the groups have laid out. And what's worth noting is the more defensive side of the ledger, sort of the old telecoms, AT&T, Verizon up here. Now, again, both of those stocks, obviously a lot of different, there's a lot of 5G themes in there. There's mobile and so forth, and something like AT&T, but sort of think of them as the traditional, big sort of sluggish telecom defensive plays in the upper right. We can look at the industries a little differently. On the industry summary page, which you can get to from your member dashboard, you can break down the 6 groups there. Same groups that I just showed, but now I'm just looking at the individual charts. And the way that I've set mine up here is I'm looking at the group, and then at the bottom, I'm looking at the relative strength, the performance of that group versus the S&P 500. And this is just looking at the last 6 months. And so what's interesting is if you look down here and look at the section at the bottom where you're showing the relative movement, you can see how this group has performed relative to the S&P. I think it's worth noting that broadcasting and entertainment, which is sort of a broader media play, essentially flat, for the last 6 months on a relative basis. So, really performed well, but has come back down and now flat for the year, for the last 6 months here. Internet actually down 1.5%. But if you look at some of these, fixed line telecommunications up 14% on a relative basis. And a lot of that movement has come up in the last 2 months, which is what's so significant to note. So what I want to do is just look very quickly at those two stocks. Here we're looking at AT&T, and we've talked about AT&T before. And again, I don't want to just harp too much on these two names, but it's worth noting that you have the strongest group within communication services, the traditional telecoms as part of the fixed telecom group. AT&T's 91st percentile on the Scooter ranking, which is definitely one of the strongest names. On the relative performance here, you can see that it was flat to the S&P through July, but then toward the end of the month starts to rally. You then see that continuation through September into now. And so for the last year, up 15% on a relative basis versus the rest of the market, and in an uptrend above two upward sloping moving averages. Verizon's the other group in here, or the other stock within the group. You can see this is down a little bit today, but again, testing sort of all-time highs there, testing a 60 level, outperforming as well over the last 2 months, not as attractive as AT&T on a historical basis based on the relative performance, but still holding up pretty well. What's worth noting, and what I just wanted to point out here to sort of finish a discussion of communication services, is to remember this. When we're looking at something like AT&T, we're looking at on an adjusted basis, meaning we're adjusting for dividends. So this chart is going up and to the right because we're taking all the dividends into consideration. And you can see AT&T pays a 5.5%, 6% yield over the last year, which means there's a huge dividend component that's causing this price to go up. And that's why it's outperformed by so much. If you put the little underscore in front of a ticker, you'll actually take the dividends out and you're just looking at the unadjusted price history. You can see that AT&T is still done just fine, but when you take the dividend component, half the relative returns over the last 2 months are really based on the dividend component, not just on the price. When you're looking at something like utilities, telecoms, even real estate, the dividend component pretty key to pay attention to. That was a quick look, a deep dive into communication services. We'll dig more into that in a future show. I want to wrap up today by looking at the 3 in 3. And again, every day on the final bar, we like to look at 3 charts in 3 minutes, go very quickly through the themes that you want to pay attention to. So we're going to go quickly through these 3. The first one is the S&P 500 with new highs and new lows. In the market summary, the market recap at the beginning of the show, we looked at this chart. And I just wanted to point out, again, it's still just one bar. This is just looking at today, but look at how many new highs we had today. 29 new highs on the S&P, 0 new lows. That is actually pretty unusual for what we've had over the last 2 weeks. But in the month of September, when the market was doing pretty well, retesting its previous highs, we had a lot of days with way more new highs than new lows. So if we continue to see that type of pattern, that's what potentially could move the S&P to further highs. But still early days, but that's a chart I would be watching. I also like to look at stocks and charts that look different than the broader market. So P&G, Procter & Gamble, and Consumer Staples, this is a stock that has been in a slow and steady uptrend. You can see the relative performance over the last year has been consistently strong. It's outperformed the S&P by 46% over the last 12 months. But if you look at just broke below and closed below the 50-day moving average today, and again, that's okay. That can happen, and that could be a healthy pullback. But I would definitely be watching this chart to see if this is the extent of the pullback, if we sort of stabilize with an RSI above 40, which is what we saw back here in the end of May, break below the 50-day RSI of 40, and that ended up being the next leg higher. I would watch to see if that same pattern plays out here, or if we see a follow through to the downside, which could indicate a further rotation away from consumer staples. Finally, as I mentioned, we've got a lot of earnings this week, and with a lot of names, Netflix, across sectors, but especially JP Morgan, Citigroup, both tomorrow, and other banks through the rest of the week. I'm watching these charts very closely. I'd encourage you to do the same. And on an earnings week, it's still very helpful to look at charts. Don't ignore them. You always want to look at where we're at relative to where we've been. Look to the left. And something like JP Morgan has held up really nicely over the last couple days. Last 2 weeks have certainly been a rotation in the short term up to a stronger position. If we would see an earnings beat, a follow through to the upside, a relative strength breakout, a lot of people would consider moving, reallocating to something like these banks, which would certainly change the picture for the overall markets. That was the final bar for today on Monday, October 14th. I want to thank my guest, Ryan Dietrich from LPL Research. Really appreciate him coming on, talking about the presidential cycle. Email us anytime at thefinalbar@stockcharts.com. We appreciate you watching the show and sending us your questions and feedback. Also at FinalBarSCTV on Twitter. This is Dave Keller from StockCharts.com. Have a great night.
Hi, I'm Arthur Hill,
And I'm Julius the Campanar.
and you're watching SCC TV.